Okay, good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review. My name is Benjamin Goh, Head of Research and Investor Education here at SIAS. Running a bit of a sore throat. I don't know, too much deep fried stuff over the weekend. Sunny, as usual, is looking good. Senior TA with us at SIAS. He obviously would have already bet in the right direction in the derivatives market, I suppose. Okay, so before we get going, again, the disclaimer is that SIAS is a registered charity. We are not licensed by MAS. So whatever that we talk about today, especially for specific stocks or counters, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. Okay, so we have got the next SIAS webinar, which is on the 21st of June, Wednesday, 7 p.m. So do scan this QR code to choke your seat. And also, for those of you who are not members of SIAS, we are selling the membership for $1 a month, $12 a year. Again, you can click the QR code or scan the QR code here to join us. I guess the main benefit is, of course, the subsidized prices for paid courses, as well as to be able to join the monthly SIAS session. All right, so going along with the tradition of the last few months, things happen over the weekend. It's like, I don't know, man. All right, so what happened on Saturday night, US time, was that US President Biden and the Speaker of the House, Kevin McCarthy, struck a debt deal. These are the key highlights, although the actual text is still being written. Hopefully, it'll be on the desk of the congressman by US time Monday morning. So the debt limit is going to be suspended through January 2025. So which means that next year, 2024, they don't have to go through this whole process again. And again, politically, that's a win for Joe Biden, I suppose, because that means, next year in October-ish, we're going to have the US presidential election, right? So the, politics-wise, they don't have to go through this whole drama thing again right in the middle of a US presidential election. So this is basically just suspended to January 2025. So whoever the new president is, after next year's the general election, will then have to go through this whole process again in late 2025, yes. Now, the key highlights is there are two main parts to the discretionary spending part of the US budget. Now, the US budget has got two main parts, discretionary spending and non-discretionary spending. Non-discretionary spending is the mandatory spending, things like your pension and all the stuff which by law the US government needs to pay. So it's automatic. They don't have to discuss anything, it just kicks in, just have to pay. So the the discretionary spending part, you have got two main parts. You've got the non-defense spending and the defense spending. Of course, the non-defense spending would be things like all the social programs, which the Democrats are usually focused on, and the defense spending is usually the bit which the Republicans focus on a little bit more. So the deal is that non-defense spending is going to be flat in 2024. That means this year it's no increase, and up only 1% in 2025. Right. So we're talking about fiscal year 2024. Fiscal year 2024 kicks in October, I believe. So the defense spending is going to be up 3.3% in fiscal year 2024. To get the Republicans on board, the work requirements for some of the social programs are going to be beefed up. So which means that in order to qualify for certain things like social programs or subsidized stuff, food stamps and all that, the applicants will need to prove that they are working for a number of hours per week. This is basically a demand from the Republicans to make sure that you don't have free riders and loafers basically getting free meals for doing absolutely nothing, right? Okay, and the Republicans plan to speed up energy project approvals. That means to get new pipelines, to drill more stuff. Has been scrapped, which is basically a win for the Democrats. All right. Don't really see any other big key things until the actual tax is out. Now, just to keep these things in perspective, I beg your pardon, the overall US government spending as a percentage of US GDP growth is actually, or rather has increased over the last few quarters. So if you look at the lowest part here, Q3 2022, the quarterly GDP growth, non-annualized, non-seasonally adjusted, was 3.2%, and now 3.2%, 0.2% was attributed to federal funding. That means the US government budget. So in Q4 2022, that quarter's GDP growth, again non-annualized, was 2.6%, and the government contributed 0.4%. So you can see where it's heading. In Q1 2023, the quarter GDP growth was 1.3%, not annualized, and the government contribution was 0.5%. So as you can see, the private sector and industry is kind of slowing down, but what is propelling or contributing to the tailwind pushing the economy forward, at least in Q1, was really government spending. So 0.5%, that's almost half of the GDP growth. Wow. Okay, so this debt ceiling deal actually does reduce the government budget a little bit. So the discretionary budget net is going to come down by about $60 billion for FY 2024. So this is basically a very minimal reduction. But the challenge is, of course, as you can see in Q1 2023, federal government contribution was quite a fair bit that helps to push the economy forward. So any kind of, I guess, reduction in the government spending will, of course, increase the risk. This is especially so because the US is, again, or rather still expected to hit into a recession in the second half, which is coming real soon. All right. Okay, moving on. Now, this is not a done deal. So this is just basically a deal done close to midnight on a Saturday by the US President as well as the House Speaker. Respectively, they will still have to sell the deal to their party, both the House of Representatives as well as the Senate. So both houses will need to, or rather both, the upper house and lower house will need to pass the legislation, and the timing is really tight. So the House Speaker, Kevin McCarthy, has said that he will allow at least 70, or not at least, but he will allow 72 hours for the Congress to review the text. So this is going to be Monday to Wednesday US time, 72 hours, which means that the House as well as the Senate must pass the legislation on Thursday, Friday. Okay. All right. So the House must pass first, then it's going to be passed on to the Senate, and then the Senate must pass. Now the challenge is, of course, this is a compromise deal. So the hardline left wing and hardline right wing people in Congress may or may not support the deal. So the ultra conservative Freedom House and caucus have already said they will not support the deal. So already a few representatives of the House are not going to support it. Then, of course, there's some complaints on the Democrat side. Now, the drop dead deadline, if you pass legislation, is before June 5th. That means Thursday and Friday must pass. Because June 5th, that means the Monday following next week, is that the US Treasury will run out of cash. So if it runs out of cash, some things will happen. So firstly, if you look at the 2011, the debt ceiling again was not, was not passed in time. So what happened was that the US was basically in default. There was a government shutdown, so on and so forth. So Monday is the X date. Okay, so not a done deal, although the markets are already moved. Now, the challenge is that if you take a leaf out of history, the 2008 bank bailout legislation, TARP, right? It was eventually called TARP, if you remember that. Eventually it passed, but it actually failed a vote in the House on the first vote. So when the deal was cobbled together, the stock market obviously went up. And when the first vote failed, the stock market actually tanked 8%, which is, I guess in French, it's called quite hiong. Right, so this is not a done deal, although it has not stopped the relief rally from happening. US futures are up between 0.2 to 0.5%, depending on whether S&P 500 or NASDAQ. The Singapore markets, some part of the Singapore market are very open, and I think Sunny may talk about this. But the Japanese market is right up. Nikkei 225 is up 1.6%. I have a 10-minute delay. China and Hong Kong can't really see yet. But Singapore is, I believe, are we up? I think we're up a little bit. I checked, right? Singapore is up 0.4%. So this may be the start of a relief rally. But again, there's huge risk if there's any single senator. Okay, it just takes one senator to hold up the proceedings on the Thursday, Friday. Then that means they cannot vote or the vote will fail. Okay, so they cannot vote, right? And they are not going to meet the Monday deadline. So everything is super tight. All right. Okay. Now, there is also a separate issue happening. So the money markets are going to start moving or have already started moving. If you look at the futures, the reason is because U.S. Treasury will now have to quickly sell. Okay, once the legislation is passed from next week onwards, the U.S. Treasury will have to quickly sell new bonds to rebuild its cash stockpile, because its cash stockpile by Monday is going to be very close to zero, or basically zero. So the U.S. Treasury needs to sell new T-bills. When the U.S. Treasury does that, obviously you'll drain liquidity from the market, so cash will move from the private sector to the government, and then the private sector will be holding the new bonds. So liquidity is going to be drained from the market from next week onwards. That's the best case scenario. But also keep in mind that the US Fed, that means the central bank, has been selling off its bond portfolio to the tune of up to $95 billion per month for some time. Basically, they're trying to right size their, I think at one point it was 4 trillion or 6 trillion bond portfolio. So they're trying to right size its bond portfolio. And this is obviously also drains liquidity for the market. So as you can see, the private sector is going to be stuck with a liquidity crunch sometime soon. So we don't really know what how the dynamics will play out, right? So do be aware that there could be some kind of disruption next week, at least initially. All right, so the relief rally in Asia has already started, as I mentioned just now. Okay, so with that, I'm gonna give the time over to Sunny for him to opine a little bit more with what's happening in the TA side of things.
Let me restart. Lucky this is a recording, so the post-production can cut it in. Okay, so camera okay, sound okay. Okay, so first thing, let's touch on the CME Fed rate monitor. So now we are seeing from last week, there is a 82% chance that will remain unchanged in the target rate of the Fed funds rate or the FOMC interest rate. But this week, the probability actually dropped to about 35% that we will have an unchanged decision. And another 25 basis point hike, the probability have increased to 64% from the 17% that we saw last week or even last month. So majority of the market now are pricing in a 25 basis point hike, or at least a 64% probability that we will see another 25 basis point hike. Why is this so? Of course, one thing is we are nearing to the debt ceiling agreement, which will be passing on to the Congress next week for voting. The other reason is the economic data that was published last Friday, as you can see over here, regardless of the durable goods, the core PCE price index, which is one of the index or the key indicators that the Fed is watching on the inflation front, as well as personal spending, all has come in above the market expectation or analyst consensus. So that means that two things, economy is doing very well at this moment based on the data that we see here. The second thing is, if the economy is doing well and then people are spending more and PCE price index is going up, that means inflation is going to be very sticky, hence the need to increase another 25 basis point for the next FOMC meeting, which is happening on the 14th of June. So these are the reasons contributing to the market shift or expectation of another 25 basis point hike in the next meeting that we see in June. For this week economic data, of course, we are going into the first week of June. Definitely, we will see the non-farm payroll numbers again. So this number will be the final data, the final important data that the Fed will be scrutinizing before their decision on 14th of June. And then we are expecting the non-farm payroll numbers to come in at 195,000, which is below the previous reading of 250,000. So any positive above 195,000 would sort of rubber stamp the justification of another 25 basis point hike, which will reflect in the probability of the Fed Fund Watch 2 that I showed you earlier. Unemployment rate expected to tick up 0.1% to 33.5% from the previous reading of 3.4%. So this is the important data that will drive market crazy for this week on the 2nd of June, which is Visa Day on our local market. We also have the ISM PMI data, manufacturing PMI data on Thursday. The consensus is coming at 47, just 0.1 below the previous reading of 47.1. So any reading below 50 means a contraction. So that means that it's on the manufacturing side, at least on the manufacturer side, things they are not looking they are not very optimistic of how the economy is going, given that they have a reading of below 50. So let me move to the charts now. So as you can see on my right-hand side over here, the Dow Jones Index, S&P 500, and the NASDAQ Composite all recorded more than 1% gain last Friday. This is just based on the single news itself that we are very close to a agreement on the debt ceiling. So like what Ben mentioned earlier, we still need to go through a vote, and that's not already cast in stone yet. So there might anything that deviate from, or any surprises that come out from the voting front will definitely have a lot of impact or volatility on the market as well. So you can see this is the big green bar last Friday on the Dow Jones Index. So Dow Jones Index rose a modest 1%. But I also like to take note that you can see that this uptrend line connecting the low of October as well as March provided the bounce for the Dow Jones Index. So definitely the support level to watch out for would be this green color line around the, let me see the low here. Okay, let me put in this arrow for you. So the low here is about 32,600 points. So this is the support level to watch. You can also see a triple top kind of formation since the beginning of this year. So the key resistance level at this triple top level is around the 34,282. So if you look at both this red line and the green line, you see that it's a chart pattern of an ascending triangle, and hence there is a possibility of a breakout. But whether that breakout, when the breakout will come, that is the key question, and then we want to avoid a false breakout also. So definitely on this green color uptrend line would be where traders would like to get in on that, as well as the red color line, which is the 200 days moving average. That would also provide further support to the Dow Jones Index going forward in the near term. But conservatively, I would say that let's play the index within this range bound period of this green uptrend support line as well as the resistance line until the indicators, the MACD and the RSI confirm a breakout is likely going to occur before you go double down on the long side to go long in the second half of this year. So the MACD is reading at negative 66.44, which is a negative reading below the zero baseline. So that means that there's still negative momentum currently in the Dow Jones Index points now. The RSI reading at 45.72 last Friday is 5 points below the 50-point neutral mark. So momentum is still slightly weak. So I think the Dow Jones Index is very data dependent or very sensitive to the news of the debt ceiling decision. So this is something that traders would like to watch out for trading into the next week or going into June, and the non-farm payroll data that's coming on Friday. Next, the S&P 500. So a very bullish S&P 500, as you can see, 1.3% rise last Friday. And then we are retesting again this top line, which is a double or triple top formation. And that is a major resistance kind of formation on the chart itself. So the latest closing at 4,205 points is actually above the 4,195 resistance level that you see over here. So same thing connecting the low of October and March this year, we have an uptrend line as well. We are also seeing an ascending triangle kind of formation forming on the S&P 500. Now, looking at the indicator, the MACD indicator is 0.87, and that means it's a positive reading above the zero baseline. Hence, there might still be some more positive momentum in the moving of the S&P 500 index point, and the next level to watch out for may be the upper bound of the Bollinger Band at 4213, as well as just slightly above that. This line, this high over here that we saw in August, that is around the 4325 level. So this may be the key resistance to watch out for the S&P 500. On the RSI side, the latest reading at 59.43 on Friday is about 10 points higher than the 50-point neutral mark. And we can see that it may likely head towards the 70-point overbought signal. And hence, that might be, if we reach there, there might be a reversal in the S&P 500 index point. So gauging from the RSI index, there's still 10 more points to go before we reach the oversold signal of 70 points. We may likely test the 4,300 points level. Why? Two reasons. One is because maybe we would really have a positive news from the vote in Congress that they passed the debt ceiling deal. And then on top of that, the following week, we have the 14th of June, we may have a release of the FOMC decision, which provide another catalyst for the stock market as well. But do take note, when Ben went through the weightage of the S&P 500, this if you equal weight the S&P 500, you can see that there's only a few or minority of major companies pushing the index higher. Most of the S&P 500 is still pretty sort of range bound or even slightly negative. So this is something to take note of. If a turn is going to come, it's going to come in quite fast. So this is, I would say, S&P 500 is closing on the resistance side of things, whether it's this current level that we see 4,200 or 4,300. I think traders will likely be on the sideline now, depending on whether they are trading the news of the Congress decision. So the next one would be the NASDAQ Composite Index. So this is the extraordinary thing that we see, the divergence. As you can see, the chart on the NASDAQ Composite Index is more or less in one direction, all the way uptrend, comparing to the Dow Jones Index, which is slightly coming down. So the divergence between the NASDAQ Composite Index and the Dow Jones Index is at the greatest at this point, I would say. So this Friday, big green candle up was largely led by the earnings results from NVIDIA. So which the stock itself saw a 26% rise on Thursday itself. So the tech and AI rally is still very strong in the market right now. Hence, you can see the tech-heavy NASDAQ Composite Index actually rose 2.19% on Friday. So we have also bypassed the double top formation, connecting the high in January as well as in May this year. So this resistance level might come back to haunt us and become a new support level for the NASDAQ Composite Index should a pullback occur. You can also see the 50 days and the 200 days moving average starting to move upwards, and thereby when this double top formation, this level of 12,269 coincide with the 50 or 200 days MA, that will provide a stronger support for the NASDAQ Composite Index in case of a pullback. Okay, we also have an uptrend line connecting the low in December and the low of March this year. So this will provide the lower bound or the lower range of the uptrend support channel that you see over here in green. The top side will be connecting the January high and the Friday high that we see. So this will be the temporary upper bound of the price channel moving in an upwards trend of the NASDAQ Composite Index. The MACD indicator reading at 37.55, so it is still positive. At least I'm reading that based on face value of the MACD indicator. There's still positive momentum in the NASDAQ Composite Index point. However, the RSI last Friday has already touched the 70-point mark, which is now reading at 70.1. So that means that there might be a pullback happening soon. Now we are talking about a pullback, not a reversal. So what does a pullback mean? So if you look at what happened in February, we also reached the point of about 73.5 on 2nd of February, and then we can see the NASDAQ Composite have some kind of pullback to the lower bound of the uptrend line or the uptrend channel. So maybe this scenario will likely repeat itself. So once the RSI indicator reach above 70, which will likely happen in the next few days. So Monday is a Memorial Day for US, so it might be a holiday, so it might come on Tuesday or Wednesday. That means the NASDAQ Composite Index is into the overbought territory, and a pullback would likely occur. So this point to watch, I will not get into go long, although it's a very positive sign, a very big green candle. I will want to wait for a pullback at least to the double top that you see over here, the 12,269, And then when the moving average converge on that, that will provide a stronger support, and thereby this pattern of a pullback in the primary uptrend may occur in the NASDAQ Composite Index. So do be careful if you're trying to go long, and then try to get in on a pullback to give you a margin of safety for trading the NASDAQ Composite Index. Next, I will move to the STI Index. So this is STI Index is more or less much more similar to the Dow Jones Index rather than the S&P 500 or the NASDAQ Composite. So you can see that today it has already jumped up to about 0.49, 0.5, 0.5%. So this is on the news of the debt ceiling. So on the news of last Friday rally in the major US stock market indices, STI is following in their footsteps and hence have a 0.5% jump today. However, I would say the reading on the STI index is pretty neutral. Instead of a sort of ascending triangle forming chart pattern, we sort of has a converging triangle happening. And you can see that the moving average are also moving nowhere, moving in a parallel or a range-bound kind of direction, moving sideways. So I think it's very neutral now on the STI index. We are still waiting for more data, whether it's on the debt ceiling or on the non-farm payroll numbers, and even on the interest rate decision that's coming out in the middle of June. The MACD indicator now is reading at 1.11. However, the MACD line and the signal line are both below the zero baseline. So that means that there is a slight positive momentum, but we are still not seeing a convincing cross of the MACD line above the signal line, which would mean an increase in momentum of the STI index point. So we are waiting for that to happen. And once that happens and the MACD line and signal line cross above the zero baseline, the acceleration upwards will be much stronger, and hence we will retest the April high at 3,300 and even the January high of 3,400. So this uptrend line that you see over here connecting the October and March low would likely be an area of support for the STI index going forward. Okay, next is the RSI indicator. The reading at 45.8, 5 points below the 50-point neutral mark in the RSI indicator means that momentum is still weak right now. So don't expect a jump up of the STI index anytime soon. So it's more or less last week is a sort of a accumulation week for traders where they are trying to get back in on the STI index on the lower bound of their Bollinger Band, and hence nearer to the uptrend line you see, there might be more buying coming in. So this would be an opportunity for the STI index. So once the RSI indicator crossed above the 50-point mark, it will indicate that positive momentum is starting to build up, and hence you can see that we may see some big movement in the STI index to retest the April high of 3,300. So that's what the RSI is telling us. So a quick one on the SIMSKI, which a lot of you are asking. So what I observed on the SIMSKI index is we have a cross again. So this cross is the 50 days amber line crossing below the 200 days moving average. So what that means is this is a death cross, and in the mid to long term, because this is the reading of the 50 and 200 days kind of time frame. So this is likely going to have an impact on the mid to long term of the SIMSKI index, which means that it is going to be negative. Okay, until we see a cross again, like what you see on March, then the trend will reverse. So this is a negative signal on the SIMSKI index. Of course, the target now would be the low over here that you see on 14th of March. That is the 286-point level for the SIMSKI index, and that would likely see some support coming in, because that would retest the low that we see this year in March. And should that hold, then it would be a double bottom kind of formation for the SIMSKI index. Resistance side, definitely 300 would be the first resistance to watch, which will also sort of concur with the 200 days moving average at 291 points. That will be the first resistance level for the SIMSKI index. Next, moving up, we will have the high in February at 310. Of course, year-to-date high at 314. On the MACD, it still looks a bit negative because the latest reading is negative 0.7. MACD line below the signal line means that it is still negative. However, if you take note of the MACD histogram, this negative momentum is more or less subsiding, and hence, once we have a cross of the MACD line above the signal line, that would be the start of the next bounce back up for the SIMSKI index, which would likely come around a 286-point level, which is the low of March itself if we touch there. On the RSI reading, the reading at 37.84 is pretty weak right now. So it's a pretty neutral to weak on the RSI indicator reading. And that means that STI Index will probably be also waiting for catalysts on the economic front, whether it's the debt ceiling or the non-farm payroll data before we see traders take a definitive kind of direction for the STI Index as well. So more or less pretty neutral, similar to the STI Index, but close to a support level. But we do not know whether that support level is likely going to hold and then provided the rebound over there. So we still are awaiting more data. Next week, it will be much clearer once we have more of this data coming out, especially the non-farm payroll data. Lastly, I'll touch on the Hang Seng Index. So I've been talking about this March low for quite a bit of time on the Hang Seng Index. And that is where we sort of see last Thursday and Friday, we retouched this level again, which is the 18,829 points. So HSI Index is more or less flat today, down just 0.1. And then the latest reading is 18,729. So if this level were to hold, then definitely it's a double bottom formation on the Hang Seng Index. So this would likely be a support level to watch out for. And traders would be looking at if this level hold, it will be good to go long on the Hang Seng Index. Not saying that it will be a rally coming, but at least what we see this year is likely going to be a range bound kind of action between the high side year-to-date high around 22,700 and the low side, which is what we saw in March at 18,800. So this would be likely where the HSI will be trending in the near term. On the MACD indicator, MACD now reading negative 106, so a bit more of a negative momentum in the Hang Seng Index point. The RSI is reading at 32.94, 3 points away from the 30-point trigger where it will tell us that the Hang Seng Index is oversold. So once it reaches that, I think that is the definitive point. I think traders would rush in to support the Hang Seng Index or actually buy on the low or buy on the value, and hence there might be a mean reversal or a bounce back up to at least the 200 days moving average level. So let me just pull out the 200 days moving average reading for you. Okay, so 200. Okay. Okay, so 200 days moving average reading is around the 20,146 point level. That will be the key first resistance to watch for the Hang Seng Index. If that breaks through and continue the range bound direction, then year-to-date high 22,700 will be the next resistance level to watch for the Hang Seng Index. So among the US index or even the Asian index, I think the chart pattern forming on the Hang Seng Index is the most promising, given that it's still in a range-bound kind of situation, but the indicators are aligned with what we see on the chart, hitting a support level, and a reversal might come in soon for the Hang Seng Index. So that's all I have for this week. Benjamin, anything else to add?
Yes, one more thing I forgot to mention. Last week, SGX announced that they're launching Singapore depository receipts for 3 big cap companies in Thailand. So what it means is that you have got SDRs, which are, for these 3 companies listed on SGX. So the 3 companies are the airports of Thailand, CPO, PTT, EMP, basically energy. So going forward, we're going to be talking a little bit more on these 3 companies. I've already taken a first look at them. Not too shabby, different flavors of ice cream. Like Thailand is basically the airports of Thailand is basically airports. PTT is energy, and CPL is 7-Eleven. So quite nice, 3 different sectors. So do watch out for that. So it could be quite interesting to see how this plays out, whether or not there is any kind of arbitrage opportunities. All right, so thank you very much for joining us this week. Have a great week ahead.